Have you ever wondered how the stock market works? It's a bustling world of numbers and names, but at its core, it's a place where businesses and investors converge. Let's break it down. When we talk about the stock market, we're referring to a collection of exchanges and markets where activities like buying, selling, and issuance of shares happen. These shares or stocks represent ownership in a company. Now, you might wonder, why do companies issue stocks? Well, it's a way for them to raise money. Instead of taking out a loan, they sell parts of the company to the public. So when you buy a stock, you're essentially buying a piece of that company. You become a shareholder. As a shareholder, you have a claim on part of the company's assets and earnings. That's right. You get to share in the company's success. But remember, it also means you share in any potential losses. Now, how are stock prices determined? It's all about supply and demand. When more people want to buy a stock, the price goes up. And when more people want to sell, the price goes down. It's a constant dance of numbers that reflects the perceived value of the company. But it's not just about individual stocks. The stock market as a whole is an essential part of the global economy. It's a place where companies can grow and investors can potentially profit. It's a barometer for economic health, and its movements can influence everything from personal finances to national policy. The stock market can seem complex, and in many ways it is. But understanding its basics can help demystify it. It's not just a chaotic flurry of numbers, it's a system, a marketplace, a platform for economic growth. In essence, the stock market is a marketplace for buyers and sellers to trade pieces of publicly traded companies. It's a place where dreams are built, where fortunes are made and lost, and where the economic pulse of our world beats. So, why would someone want to invest in the stock market? Well, the stock market offers several compelling reasons for someone to invest their hard-earned money. One of the primary reasons is the potential for high returns. Historically, the stock market has provided substantial returns on investments over the long term. While past performance does not guarantee future results, the long-term trend of the market is upward. Another reason to invest in the stock market is the possibility of earning income through dividends. Some companies distribute a portion of their earnings to shareholders in the form of dividends. These payments can provide an ongoing income stream, in addition to any potential profits from selling your shares at a higher price than you bought them. Investing in the stock market can also serve as a hedge against inflation. Inflation is the rate at which the general level of prices for goods and services is rising. Over time, this increase in prices can erode the purchasing power of money. However, the returns from stocks have historically outpaced inflation, helping investors protect their purchasing power. Now let's touch on the magic of compounding. Compound interest is essentially interest on interest. It's the process that makes your investments grow exponentially over time. As your investment earns returns, those returns are reinvested and can earn even more. The longer your money is invested, the more time it has to grow. This is why starting to invest early and staying invested is often advised. But remember, while the potential rewards are high, investing in the stock market also involves risks. It's important to do your homework, understand what you're investing in, and be comfortable with the level of risk you're taking on. Investing in the stock market can be a powerful tool to grow your wealth over time. So, if you're looking for an investment avenue that offers the potential for high returns, regular income, and a hedge against inflation, the stock market might just be the place for you. Now that we understand the basics, how does one actually start investing? Well, the first step is to open a brokerage account. Think of this as your gateway to the stock market. It's an account you set up with a financial institution which allows you to buy and sell stocks. Nowadays, this process is often as simple as downloading an app on your phone and signing up. Once your account is set up, the next step is to start researching companies. This is a critical part of the investment process. It's not just about picking companies you like or think are cool. It's about digging into their financial health and prospects for future growth. You might look at things like earnings reports, revenue trends, and industry analysis. There are numerous resources available online to help with this research, from financial news sites to dedicated investment platforms. After you've done your research, it's time to decide what stocks to buy. Here, it's important to remember that not all stocks are created equal. Some are more risky but offer the potential for higher returns, while others are more stable but might not grow as quickly. It's about finding the balance that works for your personal risk tolerance and investment goals. And this brings us to the concept of diversification. This is the practice of spreading your investments across a variety of stocks in different sectors. The idea is that if one stock or sector does poorly, the others might do well and offset the loss. Diversification can be a great way to manage risk in your portfolio. So, to recap, starting to invest involves setting up a brokerage account, researching companies, deciding what stocks to buy, and diversifying your portfolio. It's a process that requires time, effort, and a bit of financial savvy. But don't be discouraged. The world of investing is full of opportunities for those who are willing to take the time to understand it. Starting to invest may seem daunting, but with research and careful planning, it can be an accessible and rewarding endeavor. However, it's crucial to understand that investing in the stock market also comes with risks. Now, let's delve into these potential pitfalls. First and foremost, one of the biggest threats to your investment is market volatility. The stock market is like a roller coaster ride, with prices constantly moving up and down. Some days you might see your investment skyrocket, and on others they could take a nosedive. This volatility can be influenced by numerous factors such as political events, natural disasters, and even societal mood swings. Next up, we have economic downturns. Picture this: you've just bought shares in a company, and suddenly the economy takes a downturn. As businesses struggle, the value of your shares may plummet. This is a risk inherent in any market, but it's especially pronounced in the stock market due to its direct correlation with economic health. Then we have company-specific risks. When you buy a share, you're essentially buying a small piece of a company. If that company performs well, your shares increase in value. But what if the company doesn't do so well? What if they face a scandal, a product failure, or simply poor management? In such cases, the value of your shares could decrease dramatically, leading to losses. Lastly, there's the risk of total loss. While it's not common, it's possible to lose your entire investment in the stock market. For instance, if a company goes bankrupt and its shares become worthless, you could lose all the money you invested. So how can you manage these risks? One way is through diversification, or spreading your investments across different types of stocks and sectors. This way, if one area performs poorly, others might perform well and offset your losses. Another strategy is to invest for the long term. While the market can be volatile in the short term, over longer periods, it has historically trended upwards. While the stock market offers the potential for high returns, it's important to always be aware of the associated risks. So always do your research, stay informed, and never invest more than you're willing to lose. So, how do you balance the potential rewards against the risks? This is where the concept of risk tolerance comes into play. Risk tolerance is essentially your capacity to endure potential financial losses. This varies greatly from person to person and is influenced by factors such as your financial situation, your investing goals, and even your personal temperament. Some people might have a high risk tolerance and are comfortable with taking on more risk in the hopes of achieving higher returns. These individuals might invest more heavily in stocks, which can be volatile but offer the potential for substantial growth. On the other hand, some people might have a lower risk tolerance. They might prioritize preserving their capital over achieving high returns. These individuals might lean towards safer investments like bonds or money market funds. So, how do you assess your own risk tolerance? One way is to consider your financial goals and your timeline for achieving them. If you're investing for a long-term goal like retirement, you might be able to tolerate more risk since you have more time to recover from potential losses. But if you're investing for a short-term goal, like buying a house in 5 years, you might want to take on less risk. Another way to gauge your risk tolerance is to simply ask yourself, how would you feel if your investments experienced a significant downturn? If the thought makes you lose sleep, you probably have a lower risk tolerance. Once you understand your risk tolerance, you can use it to guide your investment decisions. And this is where the concept of a balanced portfolio comes in. A balanced portfolio includes a mix of different types of investments such as stocks, bonds, and cash. This diversification can help manage risk, as different types of investments respond differently to market conditions. By understanding your risk tolerance and carefully balancing your portfolio, you can make informed decisions that align with your financial goals.